All right, let's jump straight into this explainer. Today, we're absolutely blowing up some major assumptions because the hard data actually suggests that much of what we're taught about trading from day one is completely backwards. We are going to strip away the hype, forget all those overly complex indicators, and really look at trading, basic versus pro. We're going to discover how real professionals actually read the charts compared to the amateurs.
So, what if everything you learned about trading is just wrong? When a beginner first steps into the financial markets, they're almost immediately handed this deeply flawed, basic mindset. You know the one. You're told to chase perfection. You're taught that success is all about finding that ultimate, flawless strategy and constantly trying to predict and guess exactly what the price is going to do next. Is it going up? Is it going down? It turns into this incredibly stressful game of trying to anticipate the completely unpredictable. Because let's face the hard truth here. The market is fundamentally unpredictable. Nobody, and I mean nobody, knows exactly what it's going to do tomorrow.
And this perfectly highlights the massive divide we're focusing on today. On one side, you have basic trading, which is essentially just a guessing game. It's kind of like what you see in those modern binary or color trading apps, just pure prediction, crossing your fingers and hoping for the best. Frankly, it is the absolute worst habit you can build. Pro trading, on the other hand, it literally couldn't be more different. The professionals, the ones who actually survive and thrive long-term, they do not guess, they observe. They are entirely focused on pattern recognition, and they rely heavily on calculated risk-to-reward metrics to stay in the game.
Now, if you still think you need a crystal ball to make it, let's talk about the legendary trader Jesse Livermore. If you were to judge his career by that basic standard of guessing, honestly, he looks terrible. Why? Because his win rate was only around 30%. That means he was completely wrong the vast majority of the time. More than 2/3 of his trades absolutely tanked. And yet, he's widely considered one of the most phenomenal, successful traders to ever live.
So how does that even make sense? Well, the magic is in how he managed that 30%. His secret wasn't a perfect win rate at all. It was a massive risk-to-reward ratio. When he took a loss, he kept it tiny, a mere scratch. But when he was right, those few wins were so incredibly huge that they completely covered his last 10 to 20 losses all at once. It just goes to show you absolutely don't need to be a flawless guesser to be a pro. You just need a system that maximizes your winners and ruthlessly cuts your losers.
Section 1. The engine of the market. Let's demystify behavioral finance.
Okay, so if we aren't guessing, what exactly are we supposed to be doing? Enter behavioral finance. Now, I know that sounds like some intimidating academic term from an economics lecture, but it's actually super simple. It just means observing a specific human behavior that repeats over and over again in the markets, identifying it as a predictable pattern, and then building a strategy to trade it. Why does this work? Because since the very dawn of financial markets, they have been driven by one single thing: humans. And let's be real, human psychology hasn't changed a bit in thousands of years.
Think about the primal emotions that drive us every single day. Greed, fear, that classic fear of missing out, or FOMO, lust, hunger. These exact same emotional, highly predictable humans are the ones sitting behind the screens, buying and selling and actually moving the markets. And because of that, their collective behaviors leave very clear footprints. These emotional reactions cause the exact same patterns to repeat endlessly on the charts, no matter what asset or instrument you're looking at.
Because these human-driven patterns repeat like absolute clockwork, your entire job description as a trader has to change right now. You need to stop guessing. Literally, stop trying to figure out what the price is going to do in the next 5 minutes and start recognizing patterns. Once you spot a recurring behavior, your job is just to observe it, test it out, and build a systematic strategy to capitalize on it.
Section 2, Building a Pro Strategy. We are calling this the New York Open Blueprint.
All right, let's take this from high-level theory down to a practical, step-by-step mechanical strategy. How does a pro actually observe a pattern on a chart? Well, time windows are a huge deal because you absolutely need trading volume. So, step 1, we focus exclusively on the New York Open time window. Step 2, we zoom out to observe the 1-hour time frame and just mark our basic support and resistance zones. Step 3, we sit on our hands and wait for the price to break out of one of those zones after the bell rings, and then we look for it to pull back and retest that broken zone. When that retest happens, we look for an entry using a 15-minute candle as our trigger.
But hey, identifying that pattern is really only half the battle. You need strict, non-negotiable entry models. If we get that retest, we have to wait for a 15-minute candle to actually close in our favor,
like a nice strong bearish candle if we're going short, or a bullish one if we're going long. Only then do we actually execute the trade. And for our pro risk management, we place our stop loss safely on the other side of that zone, and we target a simple, rigid 1-to-2 risk-to-reward ratio. No exceptions.
Now it is definitely time for a reality check, because the live market is not some perfect textbook example. When you start testing this on random days, it is not going to be flawless. There will be days where the price comes all the way back to retest your zone, misses your entry order by literally $1 single, and then runs straight to your target without you. You'll see false breakouts with zero momentum, and yes, absolutely, your stop losses are going to get hit. That is totally normal, and it's exactly why testing your ideas is so incredibly crucial.
Section 3. The power of backtesting and refining the pattern.
This brings us to the ultimate secret that separates the basic amateurs from the heavy-hitting pros. You have to wrap your head around the difference between a pattern and a strategy. A pattern is just a raw observation, like noticing that the New York Open often breaks and retests a 1-hour zone. That's it. But a strategy is the whole shebang. It's a comprehensive business plan. It dictates your strict entry model, your risk management, your exact criteria for drawing those zones, and most importantly, the psychological discipline to follow those rules without cheating.
Think about it like this. When you first spot a pattern and maybe test it out randomly a handful of times, you might see it work, say, 2 or 3 times out of 5. That raw pattern might honestly only give you a 50% win rate. But guess what? If you are sticking to that 1-to-2 risk-to-reward ratio we talked about, a 50% win rate is actually highly profitable. The catch is, you can't rely on just 5 random cherry-picked tests. To see the real, unvarnished truth of how your system performs, a pro knows they have to test it across at least 100 trades.
And when you do that, when you test across an entire year of data, something really magical happens. You get actual, actionable data points. Imagine a trader who meticulously backtests their brand new strategy over hundreds of trades. As they're going through their trading journal, this glaring trend jumps right off the page. They suddenly realize that a massive chunk of their drawn-out losing streaks are consistently happening on just one specific day of the week, Monday.
Now here is where the real pro mindset kicks in. A basic trader would just get frustrated and probably abandon the strategy entirely. But a pro trader, they look at that data and just make a simple, mechanical adjustment. They completely stop trading on Mondays. By simply using their own back-tested data to cut out the toxic days, they instantly boost that mediocre 50% win rate all the way up to 70%. The strategy goes from just okay to incredibly refined and highly profitable, all without spending a dime, just by paying attention to the data.
So, let's wrap this all up with the ultimate pro checklist. First, stop guessing where the price is going. Second, observe a recurring behavioral pattern. Third, build a strict mechanical strategy around it. Next, backtest that strategy relentlessly for over 100 trades. Then, refine your data to eliminate the weak spots, like those nasty Monday sessions. And finally, execute the whole thing with absolute ironclad psychological discipline.
At the end of the day, the market isn't a casino, unless, of course, you treat it like one. The pros figured out a long time ago that human behavior repeats itself, and they are out there capitalizing on it every single day, while the basic amateurs are still just playing guessing games. So I want to leave you with this final thought as we close out today's explainer. Are you going to keep randomly guessing at the charts, or are you finally ready to do the hard work, look at the data, and find your pattern?